Hello and welcome to Earnings Echo. We put together the most important information about Intuit Inc. And if you are looking at their headline numbers today, you might be honestly just extremely confused.
Oh, definitely. It is a massive disconnect.
Right, because Intuit just posted an absolute monster quarter. I mean, smashing expectations across the board, yet the market is treating the stock like a sinking ship. So we synthesized the latest earnings reports and management commentary to give you a shortcut to understanding this deep dive.
Yeah, let us get straight into the hard facts here. For Q3 FY26, revenue hit $8.56 billion.
Which is, what, 10% jump year over year?
Exactly, a 10% jump. And adjusted earnings, or non-GAAP EPS, reached 12.80. So both of those metrics decisively beat the top end of guidance.
And management backed up that outperformance, too. I mean, they actually raised full-year FY26 guidance.
Right. We are now looking at 21.34 to 21.37 billion for revenue, and an EPS target of 23.80 to 23.85.
But then you look at the stock reaction, and it paints this highly pessimistic picture. We are seeing a glaring contrast between these beats and severe analyst panic about Intuit losing market share in the do-it-yourself tax segment.
The highly price-sensitive DIY segment, yeah.
Right, so break down the operational drivers for us. Why is there such a divergence?
Well, it really comes down to where the growth is, actually happening. The Global Business Solutions segment grew 15%, and that was entirely fueled by a massive 38% surge in their mid-market online ecosystem revenue.
Wow, 38% is huge.
It is, and the consumer segment also grew 8%, supported by Credit Karma being up 15%. But structurally, management is executing a major operational shift right now.
You mean the layoffs?
Yeah, they announced a 17% workforce reduction, which incurs a $300 million restructuring charge. And they say this is specifically aimed at margin expansion rather than pure volume.
Wait, I have to jump in here and challenge that narrative. I mean, management calls a 17% cut agility, but let us be real.
Right, it sounds like a spin.
Exactly. Because when you look at the macro tax data, there was a 2 million unit drop in IRS manual filers. Combine that with the severe headwinds, Intuit openly acknowledged among users earning under $50,000.
The lower end of the market, yeah.
Yeah, so isn't this massive layoff just a defensive scramble to protect margins because they are losing on price?
Well, management anticipated that exact skepticism, actually. And their tone on the call was highly confident. They explicitly denied that AI is disrupting their core business or causing these layoffs to save face.
Oh, so they addressed the AI fears head on.
Completely head on. Instead, they detailed how AI is the engine fueling their 38% customer growth in TurboTax Live, which is the assisted tax segment.
Oh, okay.
And that specific segment represents 88% of their total addressable market. So the layoffs are about reallocating resources away from the low-margin DIY space to feed this higher-margin beast.
Can you explain the mechanics of that for the listener? I mean, how exactly is AI fueling 38% growth in an assisted tax product?
Sure, so it is not about AI chatbots directly replacing human CPAs.
Right, that is what people usually assume.
Exactly, but it is actually about AI streamlining the heavy data entry and matching workflows for those human experts.
Oh, making them faster.
Precisely. By integrating AI, Intuit allows their tax professionals to process exponentially more complex returns in a fraction of the time. This means they can scale their highly lucrative assisted tax operations without needing to scale their human headcount at the same rate.
Okay, so think of it like a massive car dealership, shifting from selling cheap entry-level sedans to focusing entirely on luxury SUVs.
That is a great analogy.
Right. Yes, they might be selling fewer cars overall, but the profit margins are massive. They're aggressively moving toward a high ARPU model, meaning they generate significantly higher average revenue per user.
Exactly.
But does the current valuation actually reflect that strategic optimism?
No, the valuation reflects deep, deep pessimism. We can see this pretty clearly using a reverse DCF model.
And just briefly for the listener, a reverse discounted cash flow analysis is not a crystal ball, but it works backwards from the current stock price to tell us exactly what kind of growth the market expects.
Right, it is an indicator. And at a $387 share price and a 9% cost of capital, the market implies a 3.23% free cash flow compound annual growth rate.
Wow. Meaning the market is essentially pricing into it as if its growth is about to fall off a cliff down to low single digits.
Exactly, likely due to fears of AI disruption or the new IRS direct file system stealing those DIY users.
That is incredibly low, though.
It really is. Contrast that dismal 3.23% implied growth with Intuit's actual historical 14% revenue growth rate. not to mention their recent 31% free cash flow growth.
Right, those numbers do not align at all.
They do not. The math indicates the stock appears significantly undervalued at current levels, assuming they maintain their trajectory in the assisted and mid-market spaces. The market is completely ignoring the high margin pivot.
Which brings us to the most important echo for you to take away today. While the market remains hyper-focused on the loss of low-end DIY filers, Intuit's long-term investment story is successfully transitioning.
Yes, they are moving away from basic tax software.
Right, building a high ARPU, AI-assisted financial ecosystem, capturing the lucrative mid-market and assisted tax sectors.
Exactly. The underlying question you need to consider is whether the broader market will eventually value the ecosystem Intuit is building over the low-end volume segment they are shedding.
So as you watch this play out over the next few quarters, ask yourself, is the traditional DIY tax era actually dead? Or is Intuit simply the first giant to jump ship before it sinks? And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.